This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to discuss the ESG outlook and growth as activism is expected to build in 2023.
Plus, we'll look at why manufacturers like Boeing and Airbus could see higher deliveries next year.
But first, let's take a look at exchanges and how they need to refocus on revenue to help boost profitability in 2023. And this could potentially come as volatility isn't as dramatic next year as it was for this year. So right now, we're joined by Bloomberg Intelligence senior banks analyst Paul Gulberg. Hey, Paul, it's good to chat with you on this. First off, what was the year like for exchanges in 2022?
The year obviously started off with a lot of volatility with the war starting in Ukraine. You had tremendous amount of volatility in equity, commodities, so in almost everything. And then we switched to rising interest rates, so there was a ton of volatility in the fixed income space. And there was a lot of volume that came onto the exchanges. So the volumes were very strong this year, and typically when we go into a slower economic environment, that's when volumes kind of roll over and slow.
So as we think about 2023, what kind of volatility are we thinking about? What types of fee outlook do you have for your exchanges that you follow?
So we kind of looking for a bit of a switch from good volatility to bad volatility for the exchanges in that sense, as a lot of traders, if we are expecting a recession or a slow economic environment, a lot of traders just step away from the markets. So across many asset classes, we're going to see either no increase in volume or slight decreases in volume. And as it translates into the fees for the exchanges, those things are probably going to stay relatively flat.
So does that mean that people are just literally trade less and then therefore the exchanges just make less money? Like, is it simple as that?
That is as simple as that. So it's a number of contracts, a number of shares traded times the fees that these guys collect. So that's on the trading side of the business. They obviously have a lot of other businesses where they collect revenue from recurring products that they sell.
All right, Paul, you're the exchange analyst. I got to ask you about crypto exchanges. Talk to us about just kind of the credibility, the confidence level in some of these exchanges. You know, Binance, Coinbase, FTX. Those are the top three, and they represent about 60% of total spot volume. So it's pretty consolidated. But talk to us about the crypto exchange biz.
Right, absolutely. Those were the top three before the FTX disappeared off the radar. But, yeah, I mean, Binance and Coinbase still one of the biggest exchanges. Binance is predominantly an institutional player, whereas Coinbase is mostly a retail player. So we're in the middle of a crypto winter, to call it mildly. It's obviously more prolonged than the prior periods, and there is a lot of uncertainty how things are going to play out. So a lot of people, Coinbase in particular, their management is calling for regulation. They are prepared for more regulatory environment, and that's what institutional players in particular are looking for.
So then, to that point, how are those crypto exchanges going to continue to make money? Like, what's the easiest path for them? And then a similar question for the other exchanges. Like, where does that recurring safety revenue come from?
So for the crypto exchanges, and again, if we stick with Coinbase, the bulk of the revenue came from retail. And retail got way over the skis in terms of how much activity they had. So they pulled back very dramatically, and that's probably going to go through the 23 and possibly beyond that. But the institutional players are coming into the market. So the fees that they pay are obviously much smaller by a big discount, but the fact that they're in the market, they're staying in the market, they're giving some credibility to the product. So it'll be a long way out, way past the 23 for the crypto exchanges. For the traditional exchanges, remember, a lot of them derive a lot of their revenue from the recurring fees that they collect on data, on listing, on index fees, and all these other things that you can think of that go around across from trading, Intercontinental Exchange, for example, half of their revenue is recurring. NASDAQ is 3/4 of their revenue is recurring. So those fees are fairly stable. And it comes back to them to grow those recurring products, which they've done really well and should be able to continue doing it ahead.
All right, Paul, really appreciate the outlook. Thank you very much. Paul Gulberg, he's Bloomberg Intelligence Senior Banks Analyst.
All right, let's turn now to U.S. agency mortgage-backed securities, which may be poised to break their historic losing streak in 2023. Bloomberg Intelligence mortgage-backed security strategist Erica Adelberg joins us now for more. Erica, help us just put into context how bad 2022 was for the MBS market.
Well, let's put it this way. The mortgage market hasn't really seen 3 consecutive years of negative excess returns in its history. It's never even seen 2 consecutive years of negative total returns, that's unhedged returns, in its history. And I don't believe it's really seen more than about that negative 3% or so in total return. We're looking at the potential for double-digit negative returns for the first time in its history. So, that's like 3 or 4 times what we're used to seeing even in bad years. So it's pretty ugly out there.
That sounds really brutal. Dumb question, but why?
Yeah. So why it all kind of started with 2 things, really. For one thing, it's where we started the year, and we started the year at extremely, record low yields, quite tight spreads. And then you add on to that, the fuel in the fire was the Federal Reserve saying that they were no longer going to be buying the market. They were the ones who were really driving yields down and spreads tighter. So as a result, you suddenly have, a lack of demand at those levels of yields and spreads. Now, as yields and spreads have widened this year, we have seen other investors come back in. But it did leave a huge, both a hole as well as a lot of volatility in the market as, everybody's afraid to catch that falling knife as spreads were widening.
All right, let's look a bit forward here. The outlook for 2023, any better here?
Yeah, I mean, we're starting the year closer to, 4.5% to 5% yield as opposed to a low, I think, in the just over 1% yield for the index. I think we're at 1.25% in the middle of last year yield. So you already have several percent higher, both in terms of enticing investors to come in, like you're even seeing retail investors coming into the ETF market, as well as money managers who feel like there's a little bit more buffer. But the other positive, we think, and, this is all predicated on our rate view, which is predicated on our Bloomberg economics view that there might be a recession, or at least a very much of a slowing of the economy. We actually think that yields have topped out at this point. And if anything, we're expecting lower yields. Our forecast for the 10-year at the end of next year is 2.68. It's currently at 3.68. So a 100 basis point rally in 10 years would just help total returns overall. And then, these wider spread levels seem to be bringing in money managers. So from a hedged performance, we also expect mortgages will hold in a lot better next year.
So, silly question, but does the Fed not sell their mortgage-backed securities then?
Well, never say never. I mean,
Okay.
there's even that option on the table, I think, in part because they feel like if nobody's taking their quantitative tightening program seriously enough, they want to be able to say, but we could sell our holdings and that could widen spreads more. But at this point, given how much dislocation there already has been just as they announced the taper and then allowed the runoff to begin, it seems like they're already achieving their goals of slowing down the housing market if you look at any of the housing data. So we don't think that they either want to disrupt the markets that much more nor slow down the housing market, faster than they are. However, if those things start going in the opposite direction, all bets are off. Perhaps they'll at least start jawboning sales, and maybe even at some point in the distant future, consider at least small amounts of sales.
All right, I'm looking at mortgage rates here, 30-year fixed. It's pulled back, still really high relative to where it was certainly a year ago. But how's that little bit of a pullback impacting the MBS market, or is it just too small of a move?
Well, it's an interesting question because you are seeing a small pickup in purchase loans. That could just be a little bit of some people might have been waiting, for a little bit of a pullback in mortgage rates before they wanted to take out those loans. But it's really small. I mean, I think that there's a basic index which combines refis and purchases that the Mortgage Bankers Association releases weekly. So we're still talking about it being at basically almost all-time low levels. What it will help is, it keeps supply very limited in the mortgage index, which from a supply-demand standpoint is a very good thing, of course. It may or may not be great for liquidity in the short term, but at least there's not extra supply that the mortgage market has to absorb.
Mm-hmm.
So generally speaking, that's probably, we think, a tailwind for the sector.
All right, Erica, really appreciate the outlook. Thank you very much. Erica Adelberg joining us, and Bloomberg Intelligence, a mortgage-backed security strategist.
Coming up on the program, we'll see if Boeing and Airbus have what it takes to reach new heights with deliveries in 2023.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Aerospace manufacturers Boeing and Airbus could see higher deliveries in 2023, driving better profit margins and cash flow even as suppliers continue to struggle. For more on this, we're joined by Bloomberg Intelligence senior aerospace, defense, and airlines analyst George Ferguson. George, talk to us. We've seen some news, really, at least I have over the last couple of weeks, of some pretty good deliveries for Boeing. But just give us an overview of kind of what you're looking for next year for some of these aerospace manufacturers.
Yes, so they've had, I would say, decent deliveries this year. Neither one of Airbus and Boeing have hit their targeted rates of builds and deliveries, and a lot of that's been due to supplier challenges. Right? Suppliers are still struggling, I think, filling the ranks of workers and producing everything they say they are going to produce for Boeing and Airbus. So what we see in 2023 is we see both of those manufacturers continuing to fix the problems in their supply chain, which will add to builds and deliveries. Both of them have inventory airplanes, airplanes they've built, haven't been able to deliver to customers because there's parts missing and such. But we see them clearing parts of those inventories this year as they get those pieces they need to deliver customers, which will help boost rates as well. And Airbus will be looking to go to a rate of 65 a month on their A320, their most important, most profitable airplane. Right now, they're trying to build at 45. We don't think they'll get to that 65, but we think just the effort to increase that rate will push more through the manufacturing facilities. Mm-hmm. And I think that's going to lead to more deliveries for both of the manufacturers during the year.
It's the effort, right? It's the thought that counts. Who are the main suppliers for Airbus and Boeing, and who is the most vulnerable?
There's a lot of suppliers, but I think one of the bigger challenges has always been the engine makers, right? And the engine makers, there's a fair amount of investment they have to make to go to higher build rates. Back in 2018, 2019, right before the pandemic, when both the manufacturers were working on moving to much higher rates, it was the engine manufacturers at that point that were perhaps even unwilling to go to some of these higher rates. I mean, going to higher rates for an engine maker changes, your business model, let's say, because those manufacturers, they make their money on the spare parts that get delivered later when engines get maintained. And so they really don't want a surplus of engines in the marketplace. They don't want new airplanes being torn down. They subsidize essentially the cost of a new airplane. They don't want them torn down for parts. And so they kind of balked leading into the pandemic. We're not even at the rates that we were pre-pandemic at Boeing and Airbus. But I think we're back to the point where we're asking the engine makers to make more investment to build more engines and get them to the manufacturers. It's been the bigger stumbling block. And again, I think they're faced with sort of spending a lot of money to invest in more tooling to increase rate, hire more people, and they're probably the biggest challenge in 2023 to the airframers getting to the rates they want to get to.
George, you know me, I'm very interested in that private aviation game. Talk to us about those manufacturers and that market. It seems like when the pandemic hit, that market exploded as people said, I'm not getting on a plane with other people crammed into this tube. I'm going to get my own plane. So talk to us about that market.
Yeah, so 2022 was great days for the private aviation and for the manufacturers, right? Dassault, General Dynamics, Gulfstream, Textron, which does Cessna, Embraer, and Bombardier. So we saw that market, very white hot. I think that as we go into 2023, some of that heat is going to come out of that marketplace, right? And so we see the airlines continuing to increase capacity, the commercial airlines going back to 2019 levels of flying. They'll get close to it in the U.S. Probably, I don't know that they'll exceed 2019 during the year, but they'll get really close to it. Other parts of the world haven't recovered as much. But just the fact that they continue to increase capacity and get closer to that 2019 mark just shows you how much people are more comfortable getting back on commercial. And so part of this exuberance, I would say, for private aviation, was really, again, about people being, like you said, concerned about flying on commercial airliners. I think some of them will switch back. These are pretty well-heeled clients, so maybe inflation isn't the reason they come back, but, maybe just business class seat, if you're comfortable with the rest of the people in the airplane, a business class seat a lot cheaper than private aviation. So we think some of the heat comes off that market. Mm-hmm. Those manufacturers have built multi-year backlogs. A lot of them we're seeing 2, even stretching into 3 years. So the manufacturers have plenty to build. We think they'll still have a pretty nice 2023. A lot of companies make good margin on the spares and aftermarket support. We could see some of that private aviation flying diminish a little bit, and that might take a little bit of the margin shine off as that services becomes less of a proportion of total revenues.
Aw, it's so sad when you have to give up your private plane to fly business. What a bummer. Let's talk broader demand here. So what's the demand like for Airbus and Boeing jets? Like, what's going to be the end user demand here?
I think all of the aviation manufacturers are pretty insulated from any fall off in demand in 2023. I just told you those biz jet makers have 2 or 3 years of backlog. So if we get a recession here, that shouldn't be terrible with them. Boeing and Airbus have even more, right? If you look at the A320 and the 737, you got to decide what you think their ultimate, build rate is going to be, but they have 6 years, 7 years worth of backlog. So we really think even if the global economy goes through a little bit of a recession, especially for the big money-making airplanes, the 320 and 737, not much risk there that Boeing and Airbus would have to adjust down deliveries. I think as the recovery continues, you want more of their airplanes to be in that situation where they have so much backlog that there's any hiccups aren't going to require them to backpedal on build rates. I do think they probably have enough in all of the categories, but they need more wide-body demand. They'll want to be selling more wide-bodies during 2023, building those backlogs, increasing those rates so that they can get the wide-bodies to sort of help them with profits and margins a bit better as we go, to mid-decade.
Are the problems for Boeing, are they in the rearview mirror here for them? I'm thinking about the MAX and all that kind of stuff.
I think they have set themselves up for having a lot of those problems in the rearview mirror. We still think supply chain is it's not going to get totally cleared in 2023. Airbus had some pretty aggressive delivery schedules set up for the last quarter here. They've done it in a lot of other years where they really push a lot of airplanes through in the last quarter. So we know they can do it. And they had to step back from that guidance because the supply chain just wasn't going to do it for them. And so, and Airbus and Boeing's comments have been supply chain be a bit of a challenge in 2023. So for Boeing, that doesn't go away. But, a lot of other things, we think that they'll start to deliver the inventory of built airplanes they already have, right? And that's a big drag. Because when you build airplanes and you haven't delivered them to the customer and they're sitting in an airfield, you need to have teams of people that are managing, batteries and other storage issues. That's a drag on margins and profits. Mm. And we think they'll start to get rid of those airplanes, with more intensity during 2023. And they get that cash flow, which is locked up in inventory, which is going to be great for them. And as they get that supply chain to be a little more stable and they build at higher rates, they're going to see better profitability, and we think they're at the bottom of their build rates, and their supplier base is going to see better health, which helps their supplier base continue to perform for them. So we think those are the big issues, and I think all of them probably improve in 2023, but they don't go away, and I think a lot of that's an improving story for Boeing.
All right, good stuff. Bloomberg Intelligence senior aerospace, defense, and airlines analyst George Ferguson.
All right, coming up on the program, we're going to take a look ahead at North American REITs and whether or not they're likely to face slowing growth in 2023.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele. This is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide.
So they're setting the stage for 2023, right?
Yep.
Most likely we're going to see some kind of recession. Definitely going to continue to see central banks raising rates. So the yield-sensitive parts of the economy are going to be in for some real pain potentially. And that leads us to REITs, real estate investment trusts. What happens when you wind up having a slowing economy and higher rates all at the same time? So let's talk to Lindsay Dutch. She's Bloomberg Intelligence REITs and consumer hardlines analyst. Lindsay, where is the pain point going to be most acute for REITs next year?
So I think when we think about the individual sectors, there's two kind of key sectors that are facing challenges next year. One is office, just continued challenges in terms of with the future of the demand for the office space, but also on the retail side. And with retail, I think the big question is we saw after the pandemic sort of a resurgence in demand for brick and mortar stores, which has been great for these companies. But heading into next year, there's a real risk for store closings and some pressure on occupancy, which could also lead to sort of poorer rent growth, which could obviously be a challenge for some of these landlords.
So, Lindsay, you mentioned office REITs, and maybe it's just because I'm stuck here in Manhattan where I see all these huge skyscrapers and not too many people in them working. What are some of the office owners, what are they saying about really the future of work?
So I think with both office and on the retail side, there's really a big divide in terms of performance based on quality. There's going to be a big flight to quality. We're already seeing this across the two sectors. Basically, well-located, high amenity buildings are going to get demand. They're going to be able to lease those up. And the landlords who own those portfolios, will be able to, get good rent growth for them. REIT portfolios in general are above average when you think about the commercial real estate market across the board. So REITs are pretty well positioned just in terms of their portfolios. But again, there is definitely going to be a flight to quality in both sectors. And on the retail side, too, I think there's going to be more of a divide when we think about malls versus open-air shopping centers.
Right, because you're not going to get rid of all malls altogether kind of thing. So is the bad news priced?
So obviously the equity markets have had a really, really tough year. Retail REITs have actually performed better than average compared to broader REIT indexes. And some of that, does depend on, what types of properties they own. So sort of on the open air side, performance has been better, demand has been stronger. Also, there's triple net lease landlords. Obviously a complicated term, but the bottom line is those types of landlords outperform in an inflationary environment, and that's just because they're able to pass through sort of higher costs to their tenants. So those stocks are performing better than average in this type of environment.
So we are seeing, at least in the residential space, housing prices rolling over, coming down finally. And if I'm a REIT, am I out there buying buildings and stuff like that now, or am I waiting for it to get cheaper? What's my timing?
Yeah, so the transaction market across the board, not just residential, has basically come to a halt. And this is really reflecting sort of just wide bid-ask spreads. The buyers and sellers can't come to agreement on what the values are worth, in this type of environment when there's risk on the cash flow side, there's rising interest rates, and then cap rates, which are used to value the assets, have not really moved up yet to reflect those higher interest rates. And so that transaction market has, slowly grinded to a halt in the back half of this year. And we believe that transactions aren't going to pick up, until that bid-ask spread has closed. But REITs in general are likely looking to buy. So once those cap rates rise, we expect to see in multiple sectors REITs really going after portfolio expansion via acquisitions and really looking to, capitalize on their strong balance sheets and buy some assets.
So let's take a look at, say, the better part of the REIT market for 2023. Typically, I was talking to a REIT investor, and it was all about the senior housing and the student housing. Are those two like the winners now?
Obviously, there's different views on different sectors. I think one sector that we haven't discussed that I do think is going to have a solid year next year would be warehouses and industrial. I think, that has been sort of a strong sector in the past couple of years, and there might be a slight slowdown next year, but across the board, the performance out of that sector is still going to be above average. Mm-hmm. You're talking about like rent growth in the 20% range nationally in the U.S., wow. And that's pretty hard to beat in other sectors.
Talk to us about the cost side for REITs, their cost of capital, and how those trends are impacting the REIT business.
Right. So obviously higher interest rates do become a challenge, for anybody looking to raise debt or refinance some debt that might be coming due. Also, equity performance this year, no one really is looking to issue equity at this time, especially, most of these REITs are trading below their net asset value. So it's very dilutive. So they're a little bit constrained in terms of raising capital. We also have on the development side, worse asset values, like an increase in the cap rate could also impact sort of development yields and sort of the math on those projects.
In terms of the stuff that has done well, again, in terms of what I wind up hearing is popular, healthcare services, medical services, warehousing, not so much for like an Amazon, but warehousing because my apartment's too small kind of stuff. Are you seeing positive trends in those areas?
Yeah, so the warehouse, so I know Amazon has had some negative comments about capacity in their own fleet this year, but that's really an Amazon challenge. Mm-hmm. In terms of the sector, the landlords in that sector are still facing some really strong fundamental performance, just with the supply-demand balance within the sector. You mentioned healthcare as well. We also still see, that open-air shopping center. Mm-hmm. The demand is very strong in that space. I think store closings are a wild card, but there is a possibility, that these portfolios are in a better position than pre-pandemic, and that could allow them to sort of continue through, and any occupancy headwinds would be temporary.
All right, Lindsay, thanks a lot. Super appreciate Lindsay Dutch, Bloomberg Intelligence REITs and Consumer Hardlines analyst.
All right, let's shift now to ESG, where pressure is set to grow for accountability and activism in the coming year. For more, we're joined by Bloomberg Intelligence Director of U.S. ESG Research, Eric Kane. So, Eric, ESG, it remains very much in the spotlight for many investors, although there is, I think, some certainly valid skepticism out there. But give us a sense of how ESG investing was going to evolve in 2023, both from the investor standpoint and from the issuer standpoint.
I think we're set to see major shifts in ESG in 2023. First and foremost, I think, as you suggested, we're going to continue to see scrutiny and more attention being paid to all aspects of the market. So with that, I think we're going to see new regulation come into effect in Europe. We're going to see some challenges here in the U.S. in terms of Congress looking into ESG. But all of this, in my mind, really plays into, what we all expected and what we've all been pushing for, which is better transparency, more accountability, better indication of exactly what is being looked at for an ESG fund. So I think all of this actually suggests, positive change for ESG at large.
We've definitely seen pushback, though, like sort of the anti-woke investor, right? The energy security debate that cropped up with Russia invading Ukraine really, in some ways, pitted the energy transition versus energy security. And I'm wondering how this also just changes the vibe around ESG.
Another good question, and I would say the two are really not mutually exclusive in the near or longer term. Perhaps in the short term, as you suggested, we did see some kind of outflows from ESG-related funds because they tend to underweight things like energy, while energy started to kind of rebound in the short term. But when we actually look at some of the projections from groups like the International Energy Agency, what they're actually saying is, what we're seeing with the energy crisis right now is only going to solidify that move towards renewable energy and towards, a kind of carbon transition. So I think over, the next couple of years, we may see those two things actually come into line with each other.
So, Eric, I know you and the ESG team focus on investor sentiment. Tell us what that is in your mind, how you measure it, and then how the trend's been.
Sure. Yeah. So there are a couple folks on the team who look specifically at this. I'll do my best to kind of summarize their work. But essentially, what they're doing is looking at flows in and out of ESG ETFs and comparing that to flows out of non-labeled funds, and using that to basically see, how those flows, both in and out of the two types of funds, relate to each other and to give kind of a sentiment. And what we did see over the last year, which was certainly a departure from previous years, is that in the U.S., ESG had more outflows and a lower sentiment. And in Europe, I would say the sentiment remained high. But again, I think flows were not as high as they had been in previous years.
Typically, ESG has correlated with tech, mainly for the E part. And I'm wondering if that correlation has broken down and if ESG tends to track any other part of the market.
Yes, so I think it's another good point. So as you pointed out, ESG funds have tended historically to be overweight tech, as you pointed out, for that environmental reason. They typically have lower, direct emissions, lower risk of other environmental issues. So I think that's another reason why some of the ESG ETFs have kind of suffered in recent months, is because, of course, we're seeing a decline in tech. So I think that's something, that we'll certainly keep an eye on, and it's kind of counter to what we're seeing in energy. So you can make the case that as energy goes up, ESG kind of goes down, and as tech goes down, ESG goes down as well. But we'll see if that relationship is maintained in the coming year.
And I've noticed that sentiment towards ESG investing, it just feels like it's better, stronger in Europe. If that's true, why is that?
I think a lot of it has to do with politics, to be honest. There's a lot less questioning of things like climate change, which drive a lot of the flows into ESG-related ETFs. In Europe, I think investors are kind of more interested in seeing that their investments go into funds that have a positive impact, or at least labeled as what we call Article 9. Whereas in the U.S., obviously, there's more skepticism, and then that skepticism is kind of being amplified, of course, by recent, congressional inquiries into ESG. And the final piece is regulation in Europe is far more evolved. So we have regulation there that really looks more closely at disclosure, what's mandated, not only from the company level, but also from the fund level. And I think that level of transparency, that level of consistency has given investors there perhaps more confidence in ESG than what we see here in the U.S.
This year was really more about environment. The year before was more about social with a touch of governance. Do you have an idea of which one may take more precedence next year?
I see them all evolving. I think we are definitely at a tipping point with the climate. So certainly issues related to carbon emissions, financing the transition will continue to be top of mind for investors. We saw a major shift, and we covered this in our outlook too, in kind of labor markets in 2022. So it'll be really interesting to see how those play out over time. One of the things that we measured is, quits versus layoffs, and quits are much higher, suggesting that the balance of labor has kind of shifted towards the employee. With that, we saw some, renewed efforts for unionization at companies like Starbucks, Apple, and Amazon. So I think we're going to see labor being a key S issue going forward. And then I would also mention we have a lot of interest in some, what we could call perhaps emerging E issues.
Our thanks to Bloomberg Intelligence Director of ESG Research, Eric Kane.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele. This is Bloomberg.